Hello and welcome back to today's personal finance show here on Dublin City FM with me, Paul Merriman from askpaul.ie. I mentioned before the break that we had a really special guest in the studio. So I want to welcome to the studio Roy Wilkinson from Vanguard. Roy, you're welcome to the studio.
Paul, thank you very much indeed for inviting me here. It's great to be here.
And thanks for taking the time to drop in fairness. I know you've got a really busy schedule. So for listeners, we spoke over the last number of weeks about investment markets in particular, because we've also launched our new Fairstone funds to the Irish marketplace, which has a great partnership with you guys over in Vanguard. I thought it'd be great to get you into the studio to explain more to listeners, those that might be clients or not clients, a little bit about Vanguard, what Vanguard do, because I think most of the people that talk to me about Vanguard have heard about Vanguard predominantly through the S&P 500, and a lot of American content creators talking about just buy the Vanguard S&P 500.
Yeah.
And I think that's what they, in Ireland anyway, that's what they seem to relate Vanguard to. They know they're big, they know they're great, and they're linked to a lot of people talking about them in the US. Can you bring us through Vanguard, the start of Vanguard, what your guys are all about, and in particular maybe have a chat with the founder as well, Jack Bogle, and maybe go from there?
Absolutely. Well, there's a fair bit to unpack there, Paul, so I'll take one question at a time. No, but joking aside, yeah, I've been working for Vanguard for about 10 years now.
Okay.
And one of the first things that you sort of learn about Vanguard when you first start is the history. You know, it goes back, this is our 50th anniversary this year.
Okay.
So we were founded in the mid-70s by the late, great Jack Bogle. Jack was an absolute pioneer, and when he set Vanguard up as a business, he wanted to make sure that he set up a business that was really built to serve investors that invested in the funds.
Right.
What he didn't want to do was have any sort of outside interests in that business. So we set it up with no external shareholders. He set the business up as a mutual organisation. And the reason he did that is he wanted to make sure that it didn't have any sort of conflict when he was looking at trying to invest on behalf of clients. He wanted to make sure that all of the focus was going in to the clients that invested in the funds, and ultimately the funds own the business. So that's what he did. That's the structure of the business back in the mid-70s. And what that has meant is we're able to have a really pure client focus and make sure that we don't get distracted by external shareholders when we're making decisions on behalf of our investors.
Brilliant. And that's such a key part of the whole Bogle story, isn't it? Is making value for investors as that kind of mom and pop investor rather than, you know, the big typical Wall Street guys, isn't it?
Yeah, I think you've probably heard me say it before, but it's a business that's been set up to look after the mums and pops on Main Street. Yeah. Not after to look after the rich people on Wall Street. That's the kind of mantra of the business, if you like. Bringing investing to the masses.
Okay, and over 50 years you've certainly done that. What is it, over 11 trillion under management? They're not far off it?
Yeah.
Yeah, which is just phenomenal scale and size.
Yeah, it is scale, but scale it's never been an objective of the business when we set the business up in the first place, all the way back to Jack. The objective was to try and make sure that any scale that we do generate, the economies of scale that we get from that, so we start to enjoy that as a business, are able to be passed directly back to investors. So, you know, over the 50 years, we think we've saved investors around $1 trillion in terms of savings because of the fact that we've been lowering fees as we've generated scale. Yeah,
it's unbelievable. I remember actually being in Vanguard's office in London when we were putting these funds together, and even your mission statement, all about value to clients. And I think that's what really excited me most about bringing something to the Irish marketplace, because for years the Irish market, the marketplace in the whole, has been led by predominantly life companies, which are there to serve a really good purpose, I suppose. But some of the fund development I've seen over the years has been the complete opposite. They've almost been like a marketing ploy to get more people to invest. So they're using, like, I remember even one of the funds in particular used this kind of dynamic share to cash system where when the market gets choppy, you go into cash. But yet we all learn that that's nearly the worst thing you could do. But if you're selling it through a bank to customers and, you know, it's an easy sell. So I've always had this kind of chip on my shoulder with the industry and what they've been producing for clients, and then when you only have them in the industry, you're kind of left with not really a good selection. So I think the whole value back to consumer is so important. I think times are changing, consumers are getting way more aware, they're using the calculators, they're looking at compounding interest, they're looking at fee structures where they should be. So yeah, I think it's ultimately great what Vanguard are doing and how they're pushing them.
I think you've hit on a good point there about keeping investing simple.
Yes.
You know, I think there are so many complicated sort of fund structures around and complicated investments around. And if it's overcomplicated, and it's difficult to understand. I'm always wary of those types of investment.
Yeah.
You know, if you think about the core of Vanguard's offering all around the world, it is globally diversified, low cost investing, and buy and hold.
Yeah.
Don't overtrade, because potentially it's very easy to destroy portfolio value when you start overtrading. So, you know, we're all about simplicity, global diversification, low cost, and then just stay the course and let the markets work for you over the long term.
Yeah.
Rather than trying to build something that is overcomplicated. And as you say, often when things are built that are overcomplicated, they're kind of a bit more of a marketing ploy. Yeah. Rather than a good, solid investment.
Yeah, and then let's talk about those fundamental of investments, the principles. So you mentioned one already, which is just stay invested for the long term. And a lot of people, everyone's heard it, but I think people sometimes get it over-engineer it and over-complicate it. Because I think sometimes investors think of the cooler side of, or sexier side of investing, which is kind of buying and selling and making the right calls. That's not, number one, the advisor's job, or number two, certainly not the client's job, really, is it? It's really to hand it over, get professional low-cost investing in place, and make sure it's done for you.
Yeah, absolutely. You've hit on a good point there. I think when there's something called the behavior gap, and you know, human behavior tends to do the wrong thing when investing, because what we tend to do as humans is when we see markets or a particular fund perform really, really well, and it's producing great returns, we tend to get really excited and we want to get in. We get FOMO,
yeah,
you know, fear of missing out, and we want to jump into that investment just as it's had a really good run. And what we did, so we tend to buy high, yes, as investors, as a human species. That's what we tend to do. And then what happens is, when the investment has a bit of a drawdown and markets go against it and things don't go so well, we tend to want to get me out. Yeah. So the GMO, so you get FOMO on the way up, so you buy in when it's high, and GMO, get me out, because you can't stomach the ride on the way down. And the trouble is, if you do that again and again and again, you can quite clearly see how you're just going to destroy portfolio value. And not to mention the frictional trading costs of coming in and out of these funds all the time.
And there might be tax implications as well.
100%, yeah. So I mean, the investors that are lucky enough to have a financial advisor working with them, or financial planner working with them, you'll have that financial planner as a behavioural coach, ultimately setting that long-term plan and helping you stay invested all the way along, even if the journey is a little bit rocky. For those that don't have, aren't lucky enough to have a professional financial advisor, it's getting themselves disciplined, provided they've got a broadly diversified proposition and they're not over-concentrated. It's getting disciplined to say, even when markets are choppy, that's the very worst time for me to pull out, because I'm crystallizing losses and it's not going to do me any good for my long-term financial future.
You mentioned a really good word there. I think it's that coaching part. I think as a financial planner, it's almost like a coach to your client rather than anything to do with investment picking, and it should be. You're talking to clients, and even quite recently had a client that was looking to come out of the fund towards retirement age, and luckily we structured it correctly almost 5 years ago. So again, it's about trying to plan in advance and making sure you're not leaving it by chance, or not leaving yourself in the markets where you have to react on the day that the markets are down. So there's so much around that coaching and behavioural finance that I just think clients sometimes almost overlook it. And you know, I'm all about charging structures, I'm all about making sure everyone's getting value for money, but also staying the course of investing and making sure someone's there to hold your hand through that turbulent time. And I think it's so important. And I know I would say that as an advisor, because I found it seemed like I'm trying to talk myself up or talk the industry up, but that advice piece, and somebody's not, you know, linked to your money in an emotional way. Like, even I hand my money over to be invested. I've never invested my own money as in day trading or something, because it just wouldn't suit my personality. I'll be too emotionally attached to my own money. So almost having someone in the middle, helping you from the coaching piece, and yes, where to find the best funds and the best value, that kind of stuff, and looking at an overall financial plan. I just think I think everyone in the country needs to have a financial planner, regardless of stage, to help them with that piece.
Yeah, you're absolutely right. You know, if there is access and if people can afford to get a financial planner, I think it's very important that they do. I think this behavioural coaching piece is really important. We've done studies over the last 25 years in the US and more lately over here in Europe. And our study looks at the value of advice and the value that advisors bring to investors over and above a self-directed average investor.
Yeah.
And it's a significant value. You know, we think it's typically 3% per annum. You know, that won't happen every year all at once. But the biggest value add is this behavioural coaching. It's like half of the value that we think advisors deliver to investors is through behavioural coaching. And that is stopping them, buy when things are high and sell when things are low, ultimately.
Yeah.
And I think you've absolutely hit on a great point. It's very difficult to do when it's your own money.
Yes.
Because you have that deep emotional connection. It's yours, you've earned it, it's your family, you want to look after your family. Therefore, sometimes you can get that loss aversion that kicks in a little bit earlier than it would do normally, because of that emotional connection. But the job of your advisor is to help you tune out that noise and to stop you, falling foul of those behavioural biases that we all often display, particularly when it's our own money.
Yeah, 100%. I also remember my career, and I started off my career early on. I was in Irish Life, and it was a advisor role, but it was a sales role. You define client, sell a product. That was really it. And the industry's completely changed in the last 15 years, especially with the introduction to the Certified Financial Planner program in Ireland. I was one of the first CFPs through UCD. I think it's 12 years ago at this stage, not far off it.
You're showing your age here, yeah. So
I was 20. But I remember sitting the CFP, and I remember, I'm trying to be too dramatic on this, but I do remember really thinking, wow, this is literally going to change the industry and how we approach talking to clients, advising clients. Like in the CFP, you have a behavioural finance piece, obviously the investment piece, the tax piece, and you put it all together. But one of the guys in Irish Life, I actually left Irish Life on the second module of the CFP because it was my belief I couldn't be a CFP and be tied to Irish Life. I genuinely believe that because I think if you're trying to do that whole CFP piece, you have to have your kind of mass market opportunity for your clients rather than just one product, especially if it was more expensive than others. But sorry, at the time, there was a guy called Sean Haverty, and I remember even after the financial crash, which obviously Ireland was hammered with because you were completely over leveraged in the property sector, I remember him saying something to me, and I'll never forget it. It was like, every crash feels like the worst crash until you've gone through a few of them. Yeah. And I only really got that back in COVID. So when COVID happened, it's been the first big one since the recession in 2007, rather. And we set up what's called the Ask Paul Investment Club. Everyone was nervous. Stock markets were down, I think in April, about 20-odd%, maybe even 30%. I was like, this is the right time to invest. I'm going to set up a monthly contribution. I'm going to put money into a fund. If somebody wants, about 3,500 people, I think, ended up with accounts with us. But we showed them in the middle of COVID, and then within 2 or 3 months, the losses were gone and the gains were starting to fly. And I think it was a real good example of, when people typically were running out of markets, we were setting accounts up for people through that education piece. Yeah. And I always feel that as an advisor, the experience that I lived through in 2007 helped me in that, where if I was only an advisor out on my own probably, or starting my career in 2020 or 2020, I would probably have been very nervous of COVID because I wouldn't experience it before. So I think what you're getting from advisors should be that cyclical experience, and also trying to get your advisor to, not say show you everything they have, but I take pride in showing my clients my investment account, my pension account, my inheritance tax plan, and myself and Sarah have for the kids, because I'd like to think I'm leading by example and showing us that whole advisor relationship is just, I think it's, I know I would say this again, but I do think it's price. Actually, you've put a price on, it's 3% a year almost. Almost. Roy, talk to us again about the whole Vanguard proposition around investing, because we mentioned this on the show last week, and it was don't buy the needle, buy the haystack. And Bernard Walsh, head of investments here at Fairstone, as Paul was in with us last week chatting about it. Can you give listeners a little bit more context to that in relation to the approach that Bogle would have really supported here?
Yeah, so Bogle, as I said earlier on, Bogle was a big fan of being really very well globally diversified. He used to say it's the only free lunch in investing, diversification. The trouble is trying to find those 1 or 2 winning stocks in a whole global market, which has got thousands and thousands and thousands of stocks in it, is incredibly difficult to do. So Bogle's view was, rather than try and find a process to find those individual stocks that are going to be absolute winners and be, make you incredibly rich, then actually there's another way of doing things. You could buy the whole market, all the stocks at very, very low cost, and then ultimately let those markets drive your returns for you. And, it's called index investing ultimately. And ultimately, Jack Bogle brought index investing to the retail investor. So there were index funds that had been designed for institutional investors, but he was the first one to bring that index investing to the mums and the pops in the US when he first set the business up, and give them access to an index fund effectively.
Okay.
And if you look at how popular index funds are now and how much they've ultimately driven returns for investors and saved fees for investors, it's pretty phenomenal.
Yeah.
I mean, more so over in the US, but it's gaining much more popularity here over in Europe as well.
Yeah, I actually just mentioned a good point there, two things, Europe and the US. So if you look at the financial planning landscape in the US in particular, they're quite astute. You know, they talk about dinner tables, they're talking about their salaries, they're talking about their futures, their trust funds, their kids, etc., etc. Like, it's a really well-learned topic. And tax treatment's much better than it is here as well. And I'm hoping, we have the budget here, the budget for next year, for 2026, happening in the coming weeks. And we're hoping that the Minister for Finance will bring down tax. And I think there's hopefully, I know Vanguard have led this. I spoke at one of your events recently in the year. Actually, I think that was actually late last year. God, that flew in. Late last year, talking about trying to drive change through the taxation system. So in Ireland, we've got a 41% exit tax, where capital gains is only 33%. So if you're in a life company fund, it's 41%. In a kind of CGT portfolio, direct equities is 33. So we're hoping we're going to see that come down. And I think that harmonisation, you mentioned the EU there, I can see a harmonisation throughout the EU, because I think the EU, before it gains any real scale investing-wise, and they get more into index and they get more into investing as an actual population, you really need to see a harmonisation, a tax through it first. So we're hoping that's going to happen this year. So I think if that does happen, I'll be back in the EU for it to be really scaling the investment opportunity they have. Because like, even here in Norway, we have 160 billion in overnight deposits, which is Ireland zero. Like, it's mental. It's so scary.
I guess the good thing is you tend to find people are quite disciplined in terms of saving.
Yes.
But the bad thing is they're probably getting really poor returns, because they're languishing in accounts that aren't really giving them much return.
Yeah.
So we're big fans of savers to investors, as we're talking about it across Europe at the moment. Our senior leadership team, our government relations team, work really hard on working with policymakers, working with regulators to try and work out what is a good landscape from a tax perspective to start to encourage people to move from saving to investing. Because they move from saving to investing and they're in a portfolio that they can cope with, they can stomach, so they don't pull out of that portfolio, then their chances over the long term of better returns are so much more significant than they would be if they were languishing in a deposit account that's hardly producing them any return whatsoever. Yeah. And sometimes it's just about that education. Investing, when you start Googling investing, you can see all sorts of horror stories and people start really worrying, oh, it's gambling, and it does frustrate me. Yeah. A well-diversified, globally diversified fund, maybe with a balance, if it's a multi-asset fund with a balance of equity, so stocks and shares, and also fixed income, so slightly lower risk bonds, put that portfolio together, that will give you on average, a much better chance of getting much better returns than languishing in a deposit account, provided you've got your, obviously, safety monies put to one side as well. Yeah. And so we've been working hard on that, and we're trying to encourage more and more people to start investing rather than just keep their money in savings accounts, and policymakers to make sure that the rules and the taxation in various different countries across the EU and across the globe where we're active are conducive to making people get more comfortable with investing. Yeah,
that's actually really needed here in Ireland, because if you look even over in the UK, you have your ISAs. We've nothing like that here either. So, I think the Irish marketplace is still in a quite, it's in its infancy, I suppose, when it comes to investing, and probably mainly, right across mainland Europe as well. So I do think there's going to be a big shift and a big change, which I am quite excited about, because obviously we've been beating the drum here. And askpaul is 9 years this year, maybe it's going to 10th year next year. So for 9 years we've been trying to beat this drum, but yet when you have tax and things going against you, but I always say to people as well, don't let the tax body, because the tax is on the growth. So it means you're making money, even with the 41%, or even if it was 33%, you're still making money. But yeah, if people can look at that long term, forget about those negative stories or forget about those negative years. Like, I still meet clients will talk to me about 2007, and you're kind of going, guys, that was like a once in a 100-year event. It was just such an anomaly, and look what's happened since. But they just, their granddad got burned, their parents got burned, just have such a negative output. So it's such a shame, and especially like I said, when you look at the diversification and global reach, etc., etc., it really brings down the risk of these things. And once you know how to get coached through them, what to do when things go wrong, you're just at in my opinion, at an advantage.
Yeah, I think it's all about understanding what investing's about. You know, it doesn't, you never get a straight line from the bottom left of the graph to the top right of the graph.
No,
that's just not the world of investing.
Not gonna happen.
You know, by the very nature, you know, you will have peaks and troughs when you're investing. But if you go back long enough and you look at various different indices, like let's just say global market indices, just look at equities, you have bear markets and you have bull markets, but predominantly the bull markets are much longer in duration and produce great returns, and the bear markets tend to have sharper drawdowns but be over a shorter period of time. So I guess that if you think back to the Jack Bogle stay the course, if you can stay the course through one of those down periods, then ultimately you reap the rewards back on the upside.
Yeah.
But the trouble is, people crystallize that loss because they get that get me out, as I was mentioning earlier on, and they pull their money out. So I think investing is an incredibly powerful tool, but you need to understand that it is a journey that you have to go on. It isn't always going to, you can't, if you check your valuation every day and you get scared if you've lost any money, then, you know, you need to coach yourself to stick with it.
And especially actually on that point, when you're looking at pension investing, some clients can't access their pension. They're in their 30s or 40s for 20 years. So they should just be staying the course because, you know, whatever about cash, and you actually a good point there is one about making sure your short-term cash is in, like, you know, overnights or very short-term accounts. So any of that longer money you don't need invested, and especially when it comes to pension, because you're not actually able to physically touch it anyway. So it should be an easier decision if you know you can't touch the money for 20 years. It should psychologically be easier for you to invest and forget.
You're absolutely right, but you still do get some people falling into that trap.
Oh, you're thinking,
oh, I'm going to switch this fund because that one's done really well recently, and I typically switch into one that's almost at the top of its cycle.
And because they think they're Warren Buffett, which is fine, and I like the way people get involved in investing. They like it and they want to learn more, but it's almost next to impossible. You know, I would literally say it is physically impossible for me, even after 20 years experience, all the qualifications, it's physically impossible for me to beat Vanguard in relation to a performance of an overall fund, in my opinion. I think that's when egos have to just go against themselves to be able to say, this is not what I'm made to do. I'm made to do this. And you know, if you're self-employed or you own your business or you're, you know, a PAYE worker, you're a teacher, you're a doctor, whatever's going on in your life, that's your job. Your job isn't to pick up an hour of YouTube on a Friday or Saturday evening and then start investing your money. In my opinion, I think that's absolutely crazy. I know people do it, but I just think I think it's next to impossible to beat the market in that case, because just the psychological piece is going to ruin you.
It's hard. You know, if I think about investment principles, we think goals, balance, cost, and discipline. Goals is what are the goals, what you are actually looking to achieve with this investment that you're going to make. Balance, have you set out a well-diversified, balanced portfolio? And if it's a multi-asset portfolio with some higher risk assets and lower risk assets in there. Cost, are you accessing those investments at the lowest possible cost for the investment element of the investments? And discipline, we've talked about it a lot today.
Yeah. Stay away.
Yeah. Do not start to make tweaks to that portfolio when markets are volatile. Yeah. It's not going to help. Other than, of course, rebalancing, which is obviously very important to, you know, to maintain that portfolio with your own personal risk profile. Well,
that's really the risk profile, which is important. I think that's another thing people don't probably realize. They didn't have to go in, and every investment is a really high risk strategy. Those portfolios are designed with people's risk tolerance in mind, so you should get a little bit of comfort with that, I suppose. Ask you a quick question in relation to, not saying I'm trying to get you to predict the future, but I think anyone we have on the show from an investment point of view, it's hard not to mention Donald Trump's name, and it's hard not to mention the volatility he's caused. Not saying your prediction, but again, I know you're going to say stay the course, don't move, leave it where it is. But like, do you guys expect much more volatility on the back of his term and in his presidential term? What are you thinking in relation to the tariffs, etc.? Can you mind giving listeners a little bit of a flavour of what the House opinion would be here?
I think you're going to get a very Vanguard answer from me, as you would expect here. But we've done so many studies about geopolitical events in different countries over the years, and we've looked at what's the relationship between these big geopolitical events, so, you know, somebody new being elected into the White House, wars, etc., etc. And actually, in the long term of investing, you know, you're investing for the long term, whilst you do see a reaction, and markets do react sometimes to these, those reactions tend to be fairly short term, and actually fairly insignificant over the long term.
Yeah.
So I know you probably don't want me to.
No,
you probably want me to jump into talking about Trump in a bit more detail.
No, I don't. I think it's great because I'm sick of hearing it, but we mention it every week because just the general public seem to be, you know, and papers and press. So your answer is perfect. You're just trying to ease concerns. There's nothing to see. And I think if you look at it, even Liberation Day, everyone still thinks the markets are down because of all the negative press around Liberation Day and tariffs. But yet the markets are up. But you know, the press doesn't report on markets being up. So I think it was a perfect answer. It's all those different geopolitical events over long term, they just iron themselves out and there's nothing to be concerned about. And you shouldn't be betting against something in the short term anyway.
Yeah, I mean, because when you talk about betting something in the short term, you're trying to time the markets.
Yeah.
You're trying to time certain decisions. That's so difficult to get right. Really, really difficult. All of our studies have shown how hard it is to do tactical, you know, management and predict what's going to happen in the future, or try and react to certain, you know, economic indicators. Very, very difficult to get right. And that's why, yeah, that back to Bogle's by the haystack. You know, don't look for the needle in it, just by the haystack.
On that note, we started with Bogle, we started with the haystack, and we're going to finish with it. Roy, it's been a pleasure to have you in studio, buddy, and thanks a million for taking the time today to come in to me.
Brilliant, Paul. It's been great fun, and thanks for inviting me in.